Good evening, everyone. Thanks for joining us for our monthly webinar. As we complete FY23 and enter into FY24, the year brings its own share of good and bad in the last year. And we hope that FY24 will be a great year for all the investors and for us. The year has been quite decent from our perspective, while the indices, both Nifty and Nifty Mid Cap, were almost flat during FY23. The small cap index, BSE small cap, was down about 4-5%. So as such, not much money was made in the last 1 year for investors. In fact, a 1.5 year bull rally between March 2020 till about September 2021 was sort of halted, and for last 1.5 years, investors have hardly made any money. And even though indexes, as such, all the different indices have been either flat or down single digit from those levels, many of the stocks, especially companies which have created great value in the past decade, they have been down about 10, 20, 30 odd percent, many of them. And if you look at and take a view that the long-term equity on a 10-year basis CAGR is about 12-13% on an annualized basis, then these 18 months have cost almost 20% of return to investors. And if you use that as an analogy, that even though the index has not lost, or even though stocks have lost 20-30%, but you add the time cost of another 20 odd percent, then you are staring at 30-40% of losses in most of the stock portfolios which we see. In that time horizon, I would say, and Manish will talk more about our performance shortly in terms of how we have delivered in all our portfolios. As an institution, we have grown, although the growth has slipped sort of astoundingly for us. What used to be 60-70% growth rates in our AUMs in the past 4 years halted, and we came into high teens as our growth in AUMs. The year was challenging, and for past few months there have been a bit of outflows. Having said that, I am quite pleased to share that like last year, this year again, on a net inflow basis, Ambit Asset Management ranks within the top 10 players in the equity PMS industry, and hopefully will continue this for long periods of time. We'll cover the performance of our schemes, and then we'll talk about some behavioral aspects, some psychology in terms of how we are looking at things. And in fact, when we were discussing to make this newsletter, the environment around us was more grim than what it is today. The change in the stance from the central bank in India compared to global banks in terms of not raising the rate for this meeting at least has sort of brought a bit of vibrancy in the equity markets, and people are more positive this week than they were 2 weeks back. And we'll share more about it as we speak in our webinar. So I'll get my colleagues Trilok and Manish to talk about the month which went by, and the behavioral aspect of how to look at the content, the substance, and ignore the noise. Over to you.
Thank you so much, Sushant. And like Sushant very rightly said, the last 15 to 18 odd months, in fact, August, September 2021 onwards, the equity markets have been fairly challenging. And from that perspective, to get a little disillusioned, to get a little fearful of the markets and the movement, the sideways movements of the market in and around 17,500 to 18,000 levels is quite natural, right, for investors. But I think these are the times, and you'll hear more messaging on this front and this side as we go on. But the idea should always be to try and spend as much time in the market, be very clear about why you are investing and which asset class are you investing in. Equities is typically something that you invest from a long-term perspective, ideally minimum 3 to 5 years. And as long as a business is strong, where you have invested, the corporate governance practices are strong, and the earnings are growing steadily, the balance sheet is intact, then you have nothing to worry about per se. What you have to do is to ride out these tough periods, and eventually the returns and the profit growth do meet, sometimes in a non-linear fashion, but they do. So patience is really the key. And that's something that we've been highlighting as far as Coffee Can also is concerned for the last many months now, where we said that we have made certain changes and these changes are going to take effect. It's just that it takes a little bit of a time before these changes effect can really be witnessed or be seen. But now happy to share that this is a second month in a row um, where Coffee Can has performed in line with our own expectations. So if you see this month, then we've done by and large flattish returns as compared to the index, which again is by and large flattish, almost close to 15-16% returns on a since inception basis. But more importantly, the stock that I would want to highlight over here, and I would really want you to have a look at, is basically Relaxo footwears, right? Which is something that a lot of questions has arisen on, where people had questioned us as to why are we not getting rid of this stock and what is happening over here, and why is it that we are kind of holding on to this bet even in these times where the profitability seems to be just going for a toss incrementally. But now if you see in this current month, Relaxo has bounced back and bounced back very sharply, up about almost close to 10% in one single month, as compared to the CYTD performance, which stands at a very minuscule minus 5% now. The second best and the third best performing stocks for the month continue to be Titan and Nestle, which are solid, backed, consumption-based stories. And then there is Dr. Lal Path Labs as well as Astral and Aisha, which continue to be a little bit under pressure, but we do believe that the long-term story over here kind of continues to remain intact, and these have in fact kind of bottomed out. So if we move from here to the next one, which is Good and Clean. Then on a since inception basis, up about almost close to 12%. And the best performing stocks over here basically being Trent, Federal Bank, as well as Deepak Nitrate, out of which Federal and Deepak have actually shown a very remarkable and a strong bounce back. Avaz, Emphasis, and Supreme kind of continue to remain a little bit under pressure over here. If you move to the third one, which is Ambit Emerging Giants portfolio, what you realize is that we were down almost about 2% in this month, by and large in line with the market. But again, on a since inception basis, almost 2x the returns of the base index, very, very strong and a solid performance. CCL products, Hawkins and Neogen were the top three performers, while GMM, Mastec and La Opala were the bottom three performers. Moving on to the last, but surely not the least, Ambit 10x, which has delivered almost low teens kind of a return in the last 9 months, was marginally down in this month, but again, continues to remain very, very significantly ahead of the base index as far as the since inception returns are concerned. The key ideas over here basically being Go Fashion, India Mart, right, and CCL as the top three bets, and Avaz, GMM, and Loris continues to be the bottom three performers. So what messaging I can tell you from here onwards is that when you look at the last 6 months odd performance, when you look at the tough market that we've kind of prevailed in, when you look at Ambit 10x, when you look at Ambit Emerging Giants, when you look at the performance of Good and Clean in the last 6 months, and when you look at Coffee Can again in the last 2 odd months, where we've outperformed the base index by almost close to a percentage and a half, what you realize is that there have been significant changes that we made in each of these portfolios. These changes are now starting to show effect. And as we come out of the bear rally, a longish, stagnant bear rally, as the focus on India from a flow perspective comes back, as and when that happens, these stocks are ready to bounce back. These portfolios are ready to bounce back and bounce back in a very handsome manner. And the message that we want to give out from the second half of the presentation is that the time to invest essentially is now. If you look at the next slide, what you realize is that there is a lot of noise which is going on in the market, and these are typically the times when these noise kind of take effect and are amplified in magnitude multiple times, where all we look at is the grimness of the data, all we look at is the bad news which is coming through, both from a global as well as the India perspective. Now, from India perspective, it could be, CPI inflation suddenly surprising you on the negative and breaching the 6% levels in one single month, very, very unexpectedly. The noise that you'll hear in and around El Nino, where people are worried about the summer crop now and consequently the rural markets. You will hear a lot of noise about rupee touching a record low of 83, how our forex reserves had hit a multi-year low, where we had only about 11 months of import cover left. It could be the global news, like Credit Suisse, the entire banking crisis that emerged out in US, in the Silicon Valley, US inflation, European inflation being far more sticky and persisting to remain above the benchmark rates. The rate hikes which are happening from Fed as well as ECB's perspective. But what I want to tell you is that there is a certain bit of a conformity bias that prevails over here, where when the markets are in a bullish phase, and this is a conformity bias that happens all across, both from the people who are investing on your behalf as well as people whose money is being invested in the market, that conformity bias stays across the board, where everybody just tends to look at the news that suits the momentum of the market at that point of time. If the same index would have been 20,000 today, all you would have heard in and around you, every single kind of news that you would have heard would have been a good news. And if there were certain bit of a warning signs that were visible in the market, we would have drowned it out. We would have kind of overlooked it. And in a similar fashion, today, when the markets have not performed for almost a year now, what we are doing is we are only looking at the bad news and we are only looking at the risk factor. But there are certain green shoots which are available, which are visible, but we are kind of ignoring them. So what you got to do is to drown out the noise and look at the voice, right? If you move to the next slide.
2023 के 75 दिन हुए हैं। मैं उन 75 डेज की ही बात आज करना चाहता हूं। इन 75 दिनों में देश का ऐतिहासिक ग्रीन बजट आया। इन 75 दिनों में कर्नाटका के शिवमोगा में एयरपोर्ट का लोकार्पण हुआ। इन 75 दिनों में मुंबई में मेट्रो रेल का अगला फेज शुरू हुआ। इन 75 दिनों में देश में दुनिया का सबसे लंबा रिवर क्रूज चला। बेंगलुरु मैसूरू एक्सप्रेस वे शुरू हुआ। दिल्ली मुंबई एक्सप्रेस वे का एक सेक्शन शुरू किया गया। मुंबई से विशाखापट्टनम से वंदे भारत ट्रेनें चलनी शुरू हुई। आईआईटी धारवाड़ के परमानेंट कैंपस का लोकार्पण हुआ। भारत ने अंडमान और निकोबार द्वीप समूह के 21 द्वीपों को परम वीर चक्र विजेताओं के नाम किया। साथियों, इन 75 दिनों में ही भारत ने पेट्रोल में 20% इथेनॉल की ब्लेंडिंग करके E20 फ्यूल लॉन्च किया। तुमकुरू में एशिया की सबसे बड़ी आधुनिक हेलीकॉप्टर फैक्ट्री का लोकार्पण हुआ है। एयर इंडिया ने दुनिया का सबसे बड़ा एविएशन ऑर्डर दिया है। इन 75 दिनों में ही भारत ने ई संजीवनी के माध्यम से 10 करोड़ टेली कंसल्टेशन का मुकाम हासिल किया है। इन 75 दिनों में ही भारत ने 8 करोड़ नए टैप वाटर कनेक्शन देने का मुकाम हासिल किया है। इन 75 दिनों में ही यूपी उत्तराखंड में रेल नेटवर्क के 100% इलेक्ट्रिफिकेशन का काम पूरा हुआ है। साथियों, इन 75 दिनों में कूनो नेशनल पार्क में 12 चीताओं का नया बैच आया है। भारतीय महिला टीम ने अंडर 19 क्रिकेट में T20 वर्ल्ड कप जीता है। इन 75 दिनों में देश को 2 ऑस्कर जीतने की खुशी मिली है। साथियों, इन 75 दिनों में हजारों विदेशी डिप्लोमेट्स और विभिन्न संस्थाओं के प्रतिनिधि G20 की बैठकों में हिस्सा लेने के लिए भारत आए। इन 75 दिनों में G20 की 28 अहम बैठकें हुई हैं, यानी हर तीसरे दिन एक बैठक। इसी दौरान एनर्जी समिट हुई। आज ही ग्लोबल मिलेट्स कॉन्फ्रेंस हुई है। हमने देखा बेंगलुरु में हुए एयर इंडिया में हिस्सा लेने के लिए 100 से ज्यादा देश भारत आए। इन 75 दिनों में ही सिंगापुर के साथ यूपीआई लिंकेज की शुरुआत हुई। इन 75 दिनों में ही तुर्की की मदद के लिए भारत ने ऑपरेशन दोस्त चलाया। अब से कुछ घंटे पहले ही भारत बांग्लादेश गैस पाइपलाइन का लोकार्पण हुआ। ये 75 दिनों की ही इतनी लंबी लिस्ट है कि समय कम पड़ जाएगा। और मैं 75 दिन की कुछ बातें इसलिए दिखा रहा हूं कि यही इंडिया मूवमेंट का ही तो रिफ्लेक्शन है।
So that's the noise that we were referring to, which is all about looking at the glass half full, looking at the bright side. And to give you a more detailed perspective on this, I would call on to my very, very good friend Trilok to give you an update on the economy and the state of the economy and how some of these green shoots are visible right in front of us.
Yeah, hi, good evening, everybody. Thanks, Manish, for taking us through in the initial phase. As rightly pointed out, there are obviously, bits and pieces of noise versus substance that keep coming your way. It's up to you which one you want to pick up. And essentially, markets is also driven by earnings and sentiments both. Now, just to take you guys through this, one of the most important aspect, which has led to a pause in the market, or the better way to put it, maybe a drawdown in the market, has been a substantial inflation, and which is also followed by interest rate cycle. Our thoughts and belief is that interest rate cycle is probably coming to peak sooner than what most people anticipate. Led by several aspects. Inflation is clearly moderating, and this is obviously reflected with the fact that core of WP and WPI inflation both has kind of come down dramatically. In fact, as you guys remember or recollect, crude prices went up very, very sharply last year post invasion of Russia into Ukraine. That anniversarization has already behind us. And over the last few days, we have also seen a reasonable strong correction in the crude or slash several commodities, which is going to help the country as a whole. And if you also look at what's happening beyond India, across economies, inflation has started to cool off, led by a commodity price correction and also supply chain disruption, which was impacted because of COVID, has normalized. And you have seen situation in most places, normalized and just getting better from a supply chain or a perspective. Now, moving on to next, if you also look at what India is doing, apart from the fact that inflation keeps hitting you every now and then, and crude, obviously we are an energy intensive economy from a consumption perspective, and we don't produce as much as we consume. So beyond the fact and the vagaries of international prices in terms of volatility, what are we doing from a long-term perspective to overcome this short-term volatility? So one big change that the government is already focusing on, beyond what is heard from why and how India sort of ended up doing a 20% ethanol blending in a matter of 5 year period. We are also focusing on alternate and clean energy capacity building and investment over a medium to long term perspective. Now, and budget had a clearly emphasis on this particular aspect, whether you talk about the kind of alternate fuel energy or proposal to incentivize hydrogen fuel cells, or the transition in terms of capital investment subsidy that the government is going to give to the industry, or also in context of what kind of blending program we are going to sort of promote in order to ensure that our dependency on imported fuel gets lower, and also more than import content being lower over a period of time, we are not overly dependent to the vagaries of international markets in context of volatility. Now, apart from the fact that it addresses the import bill and the dependency aspect, it also will help in terms of self-sufficiency and promoting clean energy, and in subsequently meaningful capital expenditure, as well as the growth in the Indian economy. Moving on to next, you also look at perspective on, I was highlighting about supply chain issues. Now, as you all are aware, FY21 and 22, supply chain companies have seen the nightmare in the century, from A, product not being available, to B, dry bulk prices going up very sharply, to C, freight rates went going up multifold, and also everything was okay. They had obviously issued with respect to production capacity, because enough people were not available in order to run their operations smoothly. Now, if we see what's happened over the last 12 to 18 months in particular, this is an example we are sharing from a chemical sector. From 20% to 70%, that's the kind of correction we have seen in the prices. And that's mainly led by both, inventory being sort of, normalized, and then there is no further hoarding of inventory as, supply chain eases. And second, the demand also, kind of normalizing, because beyond the fact that inventory was, sort of stocked up in anticipation of, disrupted supply chain, also the demand is, kind of normalized across. And also, if you look at, the BDI, which I was, referring to, one of the important parameters to track the movements of ships, across the world in a non-crude product portfolio. This is probably now at pre-COVID levels, which essentially sees that the whole transition of supply chain have now suddenly reversed, and we will probably see a much improved supply chain environment, and thereby inflation will not be a major challenge going forward. Moving ahead, in this context, over the last 12 to 18 months, despite the fact that earnings grew over the last 18 months, and just to give you a perspective, Nifty grew around 25 odd percent, with mid and small cap growing around 35 to 40% in this time frame. FIs continue to sell India, and there are several reasons for that. But the kind of selling we have seen is never seen in the last maybe 2 decades of Indian equities. They sold nearly 2.5 lakh crores in this particular time frame, and thanks to very strong domestic flows, as well as investors in the Indian consumption story, our Nifty hasn't even sort of lost 10%. Now, had you sort of seen this scenario maybe 5 years out, of maybe in 2014, 15, 16, I mean, there would have no price for guessing that markets would have bleeded if we had seen such kind of outflows in a short span of time. So yeah, domestic flows have clearly sort of helped Indian markets to sort of withstand the kind of selling pressure we have seen from FIs. Moving ahead, if you look at core fundamentals, which is banking and financially one of the core fundamentals of the economy, that's also is on a very strong footing. In fact, if you look at the NPA, this is at probably a decade low for the sector as a whole, private in particular. PSUs also peaking at a double digit in 2017-18 is probably below 5%. Credit deposit CD ratios is extremely strong. Unlike in US or European markets, where we keep hearing that this bank has gone bust because of the credit system, or because of the asset that they invested, or because of underwriting policies that they're done, Indian banking system is very resilient. And thanks to RBI as well as the regulatory oversight, we continue to sort of grow stronger step by step every year. So that's obviously one of the core fundamentals where the earnings is driving momentum. Whereas, as I highlighted, multiples has corrected meaningfully. Moving on to next, the multiples of the market has corrected meaningfully, despite the fact that earnings have grown over the last 18 months in particular. In fact, the last, if you look at the 10-year average, market is now trading 15% below 10-year averages. In fact, and wherein the return profile or the balance sheet is substantially better than the averages. Now, by the end of this year, when the financial year 23 numbers will close, we will probably see the best, return matrices over the last decade for the Nifty, stocks. And from an earning perspective, Nifty is expected to grow at 15% compounding over the next in FY 2025 versus a 7-8% CAGR from over the last 11 years. So in a scenario where earnings are going to accelerate, return ratios are going to improve further, multiples are clearly in our favor, which makes it as one of the ideal time to invest and make money. Moving to next, in fact, the whole situation is all the more mouth-watering at the mid and small cap space. If you look at the multiple, wherein the P, the PE for a small cap, it is now at probably below Nifty and large cap valuations. Is at 0.9x versus a long-term average of 2x. So essentially, what I'm trying to say is the multiple that you're paying for buying a small cap is at discount to what you're paying for a large cap, which is very, very rare and probably unseen in the last decade. And particularly what happened post 2018 in the mid and small space, the return profile has been abysmal, to say the least. It's only 1% in small space, whereas the Nifty has delivered an 8-9% CAGR over the last 5 years. So essentially, the earnings momentum is going to stay strong thanks to strong core fundamentals of the economy. Multiples that at completely in our favor, and return ratios or return profile is amongst the best for the corporates over the last decade, which makes it as an ideal time for investors to dip in and look to sort of compound its money. That's a perspective from valuation and where we stand today. With that, I would like to hand over the call, back to the moderator for taking Q&A.
Thanks, Trilok. So would request everybody to put in their questions in the